Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Irmen.
Hello, and thank you for tuning in and coming back and listening in on today's podcast. I appreciate it as always. Today, we are going to talk about having a policy on kids or grandkids or anybody that technically is a minor. And what does that look like? I have so many people asking about it. You know, the kids might have 4-H money. They might be selling premiums. They are just getting money from grandpa and grandma, and we've been putting that in savings. Or maybe you have a 529 plan and that, fell right before they went to college in 08 or 09. Or maybe it fell in the last month or so due to the big coronavirus. Whatever those reasons are, we want to look at, should we insure a child? And is it beneficial for cash value? And so before I get started onto the cash value portion of it, there's lots of reasons why it's beneficial beyond just cash value. And number one is when we are looking at the infinite banking concept, it is beneficial because you yourself know when you read it, you either thought it's too good to be true. Why haven't I heard about it? There's no way this is possible. This is a total scam, whatever that reason was. And so some of us know that whole life is normal. Some of us know that whole life is awesome. Because guess what? Grandpa and grandma maybe bought a whole life policy on us when we were kids. Or mom and dad bought a whole life policy on us when we were kids. And so we've got the knowledge of it. It's the same thing. If we buy a policy on our children or on our grandchildren, and then we lend them the money to buy their first bicycle, to buy their first car, to go to college, and we lend them their own money and they pay it back to us, guess what? They now are taught how to use the infinite banking concept. They're taught that they don't have to go to the banks. There are other avenues to get money and to use money, and they can control it. They can decide how they want to pay it back. They understand how interest works because guess what? You become the teacher. You are teaching them some financial steps that they've never seen or heard or will not ever see or hear in the school system, from the talking heads of finances. That's just something that's not taught. If you don't have the cash, go to the bank. That's what we're taught. So it's awesome to be able to teach that. If you have read Nelson Nash's book, Becoming Your Own Banker, you will see that he talks about the generations and how grandpa and grandma should be starting a policy on the grandkids. And then you as the parents should be starting it on your grandkids. And we should always be skipping that generation because mom and dad typically have a really hard time affording a policy. So that's absolutely something that is important because we are teaching a concept and we're teaching them how to think differently about money. So beyond that, there is also the importance of the death benefit on a child. I have experienced or talked to people that have lost children. I have not lost a child, but I have talked to people that have. And when you lose a child, it takes you forever to heal. I don't know that anybody actually ever heals from that. I think that you may have a new normal from what some people tell me, but you never truly heal. When we look at the death benefit on a child, typically we might put them on as a rider to a term policy, or we might have a $25,000 death benefit because somebody told us that's what we should have on a child, just enough for a funeral. Well, let me tell you, when the funeral's done, you don't just get up and go to work the next day. That's not how that works when you lose somebody you love. And so having more death benefit on a child than $25,000 to me is super important so that you have time to be at home, you have time to heal, you have time to mourn without having to worry about where this income is going to come from to do that. Now, everybody heals in a different way. So I'm not going to say there's a right or a wrong. I'm not here to tell anybody how they need to mourn a death, but having the death benefit and having that freedom to say, I might need a year off, I might need 6 months off, I might need 3 months off. That is important for people. We are not trying to get rich off of our child's death. We are just trying to make sure that we're okay. So death benefit is super, super important. Now, how much death benefit can we have on a child? Well, the child can only have half of what mom and dad have. Half of what mom and dad have. And this is the law in most states. So if mom and dad have $1 million, we can only go up to $500,000 on the child. A lot of companies even limit us to $1 million on children, and they might not go over $1 million. They might not go over 1.5 in some cases. It really depends on the company. And a lot of that is just risk because those policies are going to continue to grow over that child's lifetime because whole life does not stay the same. The death benefit does not stay level. It continues to grow. So if that's going to grow over time, we just want to make sure that we're not insuring a child for $3 or $4 million or the life insurance companies wants to make sure that they're not insuring somebody for $3 or $4 million when they're 65 years old and their human life value is not $3 or $4 million. So we definitely need to look at that. I mean, they definitely look at those things as well. But when we talk about insurance today on a minor, it can only be half of what mom and dad have. So mom and dad need to have insurance. If grandpa and grandma want to buy insurance on the child, they can't do that unless mom and dad have insurance. And then grandpa and grandma need to justify why they're owners versus mom and dad. And it does get a little bit sticky depending on the company, depending on the case, all that good stuff. But companies understand why grandpa and grandma are doing it. They totally get that. So it's not something that is, that we can't do. It's just something that is questioned with a few questions. So keep in mind that you can't just have this, unlimited amount of life insurance on a child. Another thing that the life insurance company says is, why are you putting, $200,000 on child 1 and $300,000 on child 2? The life insurance company likes to have that the same. Now, in the case of infinite banking, a lot of times the life insurance company understands that we have 3 kids, 3 different ages, and we might be putting $3,000 of premium on each child. And so it buys what it buys. And they don't question so much what that is or why the death benefit is different because they understand we're putting the same premium in. Now, it might sound silly, and it's actually makes me a little sick to my stomach why they even have to question that. But not everybody has the best intentions, or when something goes wrong, is there one child that may perhaps go missing or be found dead because their life insurance is worth more. Again, a risk that the life insurance company has to make sure that they mitigate for and that they're watching for because there are sick people in this world. But when we look at the life insurance on the kids, a lot of times we're looking at that premium. And how much premium can I put on a child? What is normal to put on a child? Again, I have people that are doing $5,000 a year per child. and that's not buying over the million, so we're good. Or I have people that are putting $2,000 a year into a policy on a child. Now, a child's policy cannot be structured like an adult's. And so I can't get as much money to cash value. Now, this is a hang up for some people. And the reason why I started this podcast with the other reasons of why we want to do this on a child, or why we want life insurance on a child, because of those other reasons. So before I go forward, please remember what I just got done talking about, teaching them how to use the concept. When we do a policy on a child, it's going to take a little bit longer for that policy to break even. It's going to take a little bit longer for the cash value to grow. So if you're going to start a policy on somebody that's 1 versus somebody that's 15, it's a different ballgame, because at 15, we don't have as much time to create that college fund. We don't have as much time to create that vehicle fund because we started a little bit later. It works if we put a lot more money in, but if we don't have that money, it's going to grow a lot slower. It's going to be this policy that you go, oh, this is a terrible performing policy. Well, keep in mind, it's a long-term thing, and we don't have long-term before they're 18. At 1, we had long-term before they're 18. So the policy structure is a little bit different. Again, not a good enough reason for me to say, oh, don't do policies on the kids. Now, Nelson told me before I talked to him in February before he passed away in March of last year, and he told me that he had just bought a policy on his great-grandchild. I mean, he was 88 years old, or 87 at the time, buying policies on his great-grandchildren. So anybody that was born under the Nash family, they had a policy upon birth. And why was that? Babies have to be 14 days old before we can insure them with the companies that I use. And why do we want to do that at 14 days? Because we don't know if they're going to become uninsurable. Because babies can be uninsurable. Children can be uninsurable. If they have had seizures and we don't know why, or even if we do know why, we don't know that we want to take that risk. If at day 20 we find out there's a heart issue, all of a sudden we're not insurable. And so there are crazy things that happen. You might find out there's a 4-year-old that has cancer, or a 6-month-old with cancer, or a teenager with cancer. What if that teenager, let's talk about teenagers, what if that teenager gets into drugs and alcohol? We now have to say they've used illegal drugs, and all of a sudden they're uninsurable. So we want to insure those kids as soon as we possibly can. If we have a child that, and this is what we've been running into a lot lately as well, is if we have a child that is overweight. Now, I know children get chubby between certain ages, and then they grow and they're fine and whatever. But the life insurance company doesn't look at it that way, because we could have an onset to diabetes. We could be causing diabetes. They're looking at all this stuff long term, saying if you are overweight today, what is that going to look like down the road? What if we have a child that is all of a sudden got depression issues? Well, now that child might not be insurable because of the depression issues, because we have a suicide risk. So get those policies on those kids as soon as we can, because that way we have some insurance. If that child is diagnosed with, I've had kids with Crohn's or colitis, uninsurable in some cases. Unless you haven't had a flare-up in 7 to 10 years, you might be uninsurable. There are still risks with youth. And I have clients that are uninsurable, but thank goodness they had a policy when they were a child. It's not much. It might be $100,000 a death benefit, But at this point, something is better than nothing because they are now uninsurable. It is super important to get those policies on kids, even though it might not be the best performing cash value policy. Long term, they have their entire lifetime for that thing to grow and become just an amazing policy. And if they need it, if they can't use it as a 529 type plan or a college funding plan, well, maybe later on in their 40s, there's enough death benefit or enough cash value that they can use it to start a business. Or in their 30s, they can use it to start a business. Remember, everything can't be instant gratification. So it is very beneficial to start policies on kids, to start policies on grandkids. It is not better to start a policy on a kid than an adult. And I get that question a lot. Well, maybe I should start it on my child instead of myself. Well, first of all, if you don't have insurance, you can't do that. Secondly, it's not going to perform better just because they're younger. That is a huge misconception. And even at 18 or 19, granted, they're an adult, we can structure the policy different, but guess what? They have a human life value. And if they're not making enough money to justify a lot of death benefit, we can't stick a bunch of money into that policy either. So there's a lot of things to consider. It's not just as cut and dry as, oh, let's start a policy because they're underaged or they're really young and this is supposed to be better. As the adult or as the parent, you need life insurance as well. So as much as this is about cash value growth, this is also about the death benefit portion. And unless you're uninsurable, I'm going to want to see where is your death benefit? And then we can start on the kids. But start on the kids. We're looking at, depending on the age of the child, we could do probably $1,000 a year. I haven't had much success with $500 a year. But we could possibly do $1,000 a year, and up to $5,000 on a baby, and I've not hit $1 million limit. So it's definitely something to consider, and there's things along with it that need to be considered. So I hope that answered your question on should I start a policy on a kid or my kid or the grandkids or, and grandkids. That's another thing. Let's talk about grandkids. I always love it when a grandparent comes to me and says, okay, we have our first grandbaby. We're so excited. We want to put $3,000 a year into this policy. Fantastic. Love it. Think it's absolutely noble. Think it's the right thing to do. What are you going to do when you got 10 of those? That's $30,000 a year in premium. Can you afford $3,000 on every grandchild? Or is it just the first one? And I've had a couple grandparents who have started and the first two got policies and then the third, fourth, fifth one, they don't have anything because we just can't afford it on all of them. So make sure that when we start policies on grandkids, we're not starting it so expensive on one that we can't afford to start it on the other ones. Or do we want to start them? Nelson did this. He pays the first premium and everything after that, the parents pay or the grandparents paid because he was great grandpa, right? So do we want to start it and then say, okay, we're going to pay for 4 or 5 years and then mom and dad, you have to take over. So again, mom and dad have to understand what we're doing. And a lot of times we don't have the whole family understanding that. But we have to think long-term on the fact that we might have more than one. If you don't have more than one grandchild, great, then start another one down the road on that grandchild. But what I'm seeing in my practice is that we have the first 2, maybe 3 get a policy. And then after that, nope, nobody gets a policy. So, and it's not always about fair and what have you. But if you wanted to be fair and you wanted to help them all out, think long-term on that as well. And mom and dad think the same thing. Baby number 1 comes along and we want to make sure we have a policy on baby number 1. And I always kindly remind these young parents that they'll probably have more than one child. So now we need to make sure we have enough money to stick in every single policy for every single child. If you want to have a big family, keep that in mind. If you want to have a small family, great, keep that in mind. And sometimes God throws a few extra kiddos in there in the sets of twins, and now we have more kids to buy policies on. So always make sure you're looking long-term at those premiums as well, that we can constantly afford them for every child. And then once that child gets old enough, then we can hand off ownership to that child. When they're old enough and they're responsible, now we own it while they're under 18. And once they're over 18, we might want to change ownership so that they own the policy, they're paying the premium, they can take the loans. If they're not financially responsible, then great. I still own the policy. I still pay the premium. But if I need to lend them money for something, I'm going to play banker right out of their own policy. I'm going to lend them money out of their own policy. So if something happens to me as the owner and I pass away, and they are the ones that would take the policy over, they inherit their own debt. Now, that's another thing. If Johnny and Susie are not responsible and I die, I can make the contingent owner anybody I want. So upon my death, the new owner could be the neighbor, Joseph, and he's owning the policy and he's paying the premium, or my estate is set up to pay the premium, but the kids don't own that policy until they are mature enough. And in our household, our personal household, that's exactly how it's set up, is that the kids are not going to own their own policy until they are mature enough to do that. And whoever's in charge of the estate can lend them money from their policy and can pay, and she can pay that back, but she will not have control of that unless she is financially financially mature enough and just mentally mature enough to understand that that's how it works. And they're going to be set up with an agent. There's a list of names in our estate that these are the agents that the kids talk to upon our death. That's going to teach them the infinite banking concept. So that legacy continues of what we are doing and what I've set up and what I teach everybody else. And so keep that in mind as well. The ownership on that policy can be anybody you want it to be, and it can then go to the kids. Nelson he always said, I've given the policies to their rightful owners, which meant I've changed ownership of these policies to the insured. And they inherited cash value while Nelson was alive. What an amazing gift to give your kids is a policy with cash value while you're alive. You actually get to see them utilize that gift. And so that's absolutely fantastic. So you could do that as well. Or you could wait upon your death that they own these policies. I have clients that have policies on young children, that bought policies on young children, and they still own them. And I'm like, you can give those over to the kids. And they're like, no, we're not. Because the kids they're in their 30s, not financially responsible. They would cancel the policy and take the money, or they would quit paying the premium because the kids do not want to understand what this whole life is. And so they're not getting those policies. But we have ultimate control because we are the owners. So definitely something else to think about is the ownership and the insured, and the fact that they can utilize the cash value through you. You can borrow them money. You don't have to tell them where you're getting it. You can borrow them money from their own policies. You can teach them how to use the policy. You can give them the policy full of cash value or full of their loans. Even if they borrow money for college and then all of a sudden you give them ownership of that policy, now they've inherited their own debt. And they can pay that back however they want. So lots and lots of good things that can happen with a child's policy that you own, or you've owned for a short period of time when they were 15, 16, or that you've owned since they've been 14 days old. Whatever works, but start those policies knowing they're not going to be the best fast cash value growth, but long-term, they're going to be a better policy. Okay, people, I hope that helped. Please let me know if you have questions, concerns, comments, or if there is a subject that you would like me to cover. I am happy to do that. You can, if you have not gotten the book, you can go to farmingwithoutthebank.com and you can get the book there. After you've read the book, I am happy to meet with you and have a free consultation and talk about what you're doing and how I can help. But you have to read my book, Farming Without the Bank, or Wealth Without the Bank or Wall Street if you are a non-farmer, or Nelson Nash's book, Becoming Your Own Banker. You've got to educate yourself beyond this podcast and beyond YouTube videos and read one of those three. And then I am happy to meet with you and look at what you're doing and see if we can help. Otherwise, until next time, you guys have an absolutely fantastic spring. Talk to you later.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.